All right, we've got only 20 minutes here. We've got a lot of ground that I want to cover with you. But before we get into it, can you just give a quick 30-second intro to you and L1D?
So my name is Ray Hindi. I'm one of the founders of L1D. L1D is a crypto fund based out of Switzerland. We've been in business since 2018, and the way we invest is we invest in funds on the liquid side, and we invest in direct venture as well.
So guys, Ray's too humble to say this for himself, but he is one of the sharpest allocators in the space, and he has a very interesting ground view into what's going on the manager side of things as well. So that's where I kind of want to start this year, right? Like, just give me the TLDR, the kind of year-to-date post-mortem, like, how are our funds doing out there? And if you could kind of separate kind of the liquid funds from the, delta neutrals from the equity only, like, how are our fund managers doing out there?
So funds on the liquid side are not doing great. This year is probably on average one of their worst years. The biggest challenge has been beating Bitcoin, and as we become more institutional, I think some of the alpha came from not being institutional, having the operational flexibility of operating on chains that you've never heard of 2 days ago, etc. And so they've been constrained. Having said that, there are a few specialists. So for example, equities have done well. So specialists on the equity side, which a few months ago was a restricted universe, have done better. So the liquid side is suffering. Now, having said that, we have to assume and be realistic. Over, a 5, 6, 7, 8-year cycle, most of the liquid funds out there, whether it's in liquid, venture, etc., won't generate any alpha. Alpha is very, very scarce. The problem is that this year, the ones that didn't compensate for the ones that didn't, and this is something that we need to see going forward, and I'm pretty sure that we will.
And, obviously don't reveal any state secrets here, but, I'm curious, on the liquid side of things, are the managers that are doing best, you mentioned flexibility, right? So being able to maybe be a little bit more risk on in terms of experimenting, taking on technical risk, moving on to new chains. But I'm also curious on what types of strategies are performing on the liquid side to the extent that they are. Is it kind of like, what are the sort of holding periods? Is it more trading oriented? What is working out there?
Yeah, so I would say that there's the few managers that are really performing form a sort of a barbell. So I can describe it by looking at, emerging managers out there, so small size. So I've got one manager in mind who they've started their business in 22 or 23. They've started pretty aggressively by building their brand. They're fundamental in nature. But based on the fact that they run roughly $30 million, or were at $30 million at the beginning of the year, $25 to $30 million, they were able to get into situations that are less liquid, still in a diversified way, by capitalizing on that true fundamental meta that we've seen. So looking at cash flow, being very active with the projects themselves to create catalysts for positive price action, etc. So you can think of early to so you might guess who I'm talking about, but early to maybe Camino, early to SERP, early to MetaDAO, etc. So a name that you wouldn't have heard of 2 years ago that today you hear
all the time. Yeah.
All the time. So that gradual brand build-up while staying very nimble and small served them really well. A team that is very hungry, very small team, so that's really, really important. Because, it's easy. A lot of allocators always prefer to invest in emerging managers with, smaller AUMs. The assumption is that everyone's hungry, everyone has the capacity to generate alpha. The reality is that this is not the case. But if you are, and it's an advantage to be smaller. Now, there are, funds from the past cycle that have done extremely well. But unfortunately, even if you've had a fund that has generated alpha in the last 5 to 6 years, there's no guarantee for alpha going forward. In fact, in most cases, you can guarantee that they'll generate negative alpha. And that has to do with the unfortunate curse of the wealth effect in crypto. Whether you look at founders, you can name how many founders that became wealthy keep on going and pushing their projects forward. They're pretty scarce. You can apply the same with a GP out there. A GP that was very successful from 2018 to 2021, 22, etc. Today is, in most cases, you've got three scenarios. One, they give up on, they close down the fund and manage their family office. Two, they soft drug, which means that, hey, we're all human beings. We have different interests at different levels of wealth. And they start, but they want to keep their business going. And so the way they manage their business shifts in a major way. And some of the signs are very, very apparent. So for example, the major risk taker will start hiring more people and delegate a lot of functions. And you'll notice that the major risk taker is no longer involved in analyzing a deal or in discussions with the founder, because those roles were delegated. What they want to do in terms of running their GP, if they want to, have a better life, better quality of life, etc., and be less involved, they need to collapse the volatility of their revenues, the GP's revenue. And the way they do that is they start delegating to other team members and become, instead of being risk takers, they actually become risk managers. So they've got ideas that are pitched to them, and naturally, and that's in line with the fact that they want to compress the vol, they become over-diversified. So diversified portfolios this year underperformed heavily and generated negative alpha. The only ones that did well were portfolios that were heavily concentrated, i.e. the original risk taker kept the key man risk in play and pushed for the deals that they know best. And so this is the only format that actually works. So the barbell of emerging managers that are more nimble, that are still hungry, and your extremely wealthy GP that is still hungry for some reason and still pushing and expressing their conviction accordingly.
What percentage do you think fall into that second category?
I'm not sure how many funds we have out there, but I don't know, maybe 0.1%.
So pretty scarce.
I can think of one.
Okay, very scarce. Okay, let's talk a little bit about the allocator side of things. So, one hallmark, I'm just thinking about the quantum of capital that I see show up in venture deal sizes. And when I'm thinking back to 2021 and 2022, massive, $100, $200, $400 million rounds, you see far less of that today. And I think some of the funds that raise these mega fund, again, 400, 500 million, in some cases billion-dollar funds, have struggled to raise at the same size. And I'm just curious, from the allocator standpoint, how have the preferences shifted, both in terms of willingness to allocate capital, but also, maybe away from some of these mega funds that, to your point, might have gotten a little tired or maybe took their eyes off the ball into smaller funds?
Yeah, I would say that So, I mean, in 2021, 2022, we created a crypto VC bubble that we've been paying the price for it ever since. But of course, fact is that most crypto VC funds out there are unable to raise the equal amount of capital that they used to raise, and those are the good ones, the reputable ones. And most of the others are not raising anything, and many are shutting down, and that's a good thing. So, which means that the system is being cleansed, and you've got less competition going forward. I think the opportunity set is around those barbells where you're going to have, there's a few big names out there that are heavily respected. Can think of maybe 3 of them that will continuously, they're raising less, but that's a good thing. Even with the assets that they've raised in the past cycle, they were able to come up with acceptable results considering their circumstances. And you've got a small part of emerging managers out there, again, that can demonstrate a value add on the VC side, but also say that while we at L1D have been quite bearish on crypto VC for the last 2.5 years or 3 years, we're gradually becoming more favorable. And I wouldn't be surprised if, 12 months down the line, we become very aggressive within that category.
Why is that?
Simply because, most of the capital is being allocated from the past cycle. Most crypto VC funds are not raising capital, and the ones that are, and they deserve it, are raising much, much less. So the competition is much lower.
That's really interesting. From not just necessarily from the VC side of things, but do you get the sense that, because all you hear, if you're not in this market in the day-to-day, is the institutions are here, this is totally different than it was in 2021, everyone believes in the space now. I know you are allocating very aggressively at L1D. Do you get the sense that your colleagues in the kind of allocator space feel the same? Is there still some skepticism? Like, how do talk to me about that?
Yeah, sure. So I'll cover the Swiss market, which I think is the third largest market out there in terms of raising capital. So despite the fact that it's a small country, there's a lot of capital. There's a lot of family offices, but also there's 1,000 pension funds. And the pension fund market is extremely interesting for us. And we started tackling the Swiss pension market since 2018. We got our first pension fund, which was a fluke because you had a few, crypto natives within that pension funds that pushed hard. In Q4 of 2019, and that pension fund doubled down April 1st of 2020. So it was the best performing Swiss pension fund in 2021 because of crypto, which was great. But then we got a few others over time, but we worked really hard to get them. We have 9 in total today. About a year ago, whenever you would go and the only reason why we have 9 Swiss pension funds is simply a bottom-up approach. My colleagues came from that world. They're trusted by several entities out there, so it's not a top-down reason. Before that, no pension fund even considered putting crypto in the books. But today, what is happening is, the shift of the 180 shift in regulatory in the U.S. Regulatory stance has led to a governance issue around Swiss pension funds, even where if the question of do we invest in crypto is proposed, and they say yes or no, they need to have reasons for not investing. That's really, really important. Which means that I think they're taking that. They're considering that as a year ago or 2 years ago you were laughed out of the room. Today they have to do their analysis and consider and put on paper if they don't invest, why not? Which is very, very promising for us.
Shifting tacks a little bit, I'm curious. Speaking of these managers, like many of them who. Maybe after a couple of years, make a lot of money and it changes their perspective and their outlook on their life and work. What do you look for in a manager that you think is going to be successful and stand the test of time? Like when you sit down, is it some previous track record that you use? Is it psychological tells? Is it like, what do you look for and what helps you build conviction around your portfolio of managers?
Yeah, I don't think you can predict, you can't assess a manager to a point where that they'll be able to be committed to the business long term. People change. So essentially what you have to do is that you have to monitor them very, very actively. And so, as I said, there are signs of them shifting or, let's say, soft drugging you in a way. And when you're in a liquid manager, you can actually get out and change your mind. So it's really important to monitor the manager and act accordingly. So some of the signs, are they over hiring people? One of the, for some reason, allocators put a heavy weight on the brand of the manager towards other investors. And that's brand that is lagging, actually. You should check the brand of a GP towards founders, not other investors. When you can do a reference with their largest investor to understand what kind of transparency they provide, etc. But most of those references have to be with the founders. And since we are active on the direct side, we're able to triangulate that information. So we catch a change of GP brand with the founders pretty quickly. Since we're invested mostly in fundamental managers, that brand can give you a sign of, is the founder disengaged, yes or no? So is the brand deteriorating? Is he overhiring? You can actually check a GP's team social footprints, right? You can go on X, LinkedIn, even to a point Instagram, and assess where are they putting most of their effort, where are they in their phase of life. If they're more active on LinkedIn, that means that they're doing more focused on business development. They're more active on Instagram, they've checked out completely. They're focused on their fiance or girlfriend. And you see that most of the data, except Instagram, unless it's a private account, is out there. And so there's a lot of tells of signs of someone that is heavily disengaged. But most importantly, as soon as you notice that the main risk taker is not deep within a specific most of the deals within the portfolio, and the portfolio is over diversified, then you've got a problem.
Super, super interesting. I would also love to understand a little bit for you how you've managed to build conviction over time, because one thing that I know about L1D, and I don't know how much we can get into the weeds here, I guess, but you've been very, very active during times of market stress and doubling down on managers that are working and adding at a time that's really mentally difficult to do. I would guess especially that's challenging with Swiss pension funds as your client base as well. So, how do you just mentally deal with it during these periods of time and allocate when basically no one else seems to have the fortitude to?
So first, you're able to double down on a manager when you've gone through several points of stress with the manager himself. So it all goes back to trust. So there's one manager that we doubled down heavily on. December 1st, 2020, it was their worst year ever by far. And they were being trashed on social media for being, for their really bad performance, etc. But we had gone through several periods of stress or crises with that manager. We did November 2020 and many other crises. So there's a lot of trust that was built there. So that helped a lot.
And you had confidence that they would respond and not crumble and...
Yeah, we just trusted them. Whatever they told us, we believed because we went through it, and we knew, and we saw an actual pattern of you make a mistake once, you never make it again, and you learn from it and you evolve.
Yeah,
that is very, very important.
Yeah,
and the what you mentioned about the pension fund is actually the other way around. Pension funds are the most sophisticated, most rational, and the stickiest investors out there.
Oh.
And most of the flows that we saw in 2022 and 2023 came from pension funds. The worst investors out there are the ones that are very rational. That, when you have one decision maker that flips on a dime, that's a volatile investor. A pension fund has a committee to go through. Once they make a decision, they make it rationally. They cannot go back unless something structural has changed. So it's an advantage to have pension funds as investors.
And maybe, Ray, we've only got another minute here or so, but if you had any advice out there, either for existing managers or for new managers, someone that people that are looking to get into the game, I don't know, what would you counsel them?
I would say I think it's important to build your firm around, the risk taker is probably the most important person in the firm, but equally so, operations has to be solid. Your business development side of things has to be solid because you need very sophisticated and sticky investors to be with you. So you need to actually build a real firm. And unless you, if you don't want to do that, just join the firm that culturally fits with you, but you need to be very careful. So it's not an easy decision.
All right, guys. This was a lot of fun. Ray, thank you so much for doing this. Guys, give Ray a big round of applause.